January 24th, 2026. You're watching silver trade at $102 per troy ounce. Gold stands at $5,000. These are not predictions. These are not estimates. These are the actual prices being transacted right now in this moment on exchanges around the world. And if you think this is just another commodity rally, another bout of safe haven buying, another passing moment of market volatility, then you have not yet understood what is happening. This is not a rally. This is a breakout from a system that can no longer contain what it has been suppressing for decades. Silver has moved 237% in 12 months. Not 7%, not 17%, 237%. Gold, often viewed as the steady, reliable monetary metal, has climbed 80% year over year. But silver has obliterated every expectation, every forecast, every model that Wall Street constructed to explain how metals should behave. And the most important thing you need to understand right now is this. These assets are not rising because they have become more valuable. They are rising because the measurement tool itself, the dollar, is collapsing in real terms. What you are witnessing is not asset appreciation. You are witnessing currency debasement being priced into the only assets that cannot be printed into existence. For 5 consecutive years, the silver market has run a deficit. Think about what that means. For 5 straight years, global demand has exceeded mine supply. In 2025 alone, demand reached 1.24 billion ounces. Mine production delivered only 813 million ounces. That is a 400 million ounce gap in a single year. This is not a temporary imbalance. This is a structural breakdown. And the response from the financial system has been to draw down above ground inventories, to drain the warehouses, to pull metal from every vault they can access, to paper over the shortage with futures contracts and unallocated accounts, and exchange traded funds that promise you exposure to silver without giving you the actual metal. For years, this worked. The COMEX registered inventories were drawn down 70% from their 2020 peak. 346 million ounces collapsed to 82 million ounces by late 2023. London vaults bled metal. Shanghai inventories hit decade lows. But the charade continued because there was always more inventory somewhere. Always another vault to raid, always another seller willing to exchange physical for paper at a discount. And then, on January 1st, 2026, China changed the rules. China implemented export restrictions on refined silver. Only large, state-approved companies with annual production capacity exceeding 80 tons can now export. Only 44 firms have been approved for the 2026 to 2027 period. Do you understand what just happened? China, which dominates refined silver supply globally, just told the rest of the world, you can no longer rely on us to plug your deficits. The metal that was flowing from Chinese refineries to Western manufacturers and investors, that was keeping global supply chains operational, that was preventing the physical shortage from becoming visible in the price, is being cut off, and the impact has been immediate and catastrophic. Silver lease rates, the cost of borrowing physical metal, spiked to over 8% annualized. In some periods of acute tightness, borrowing costs hit 200% on an annualized basis. These are not the numbers you see in a functioning market. These are the numbers you see when the system is breaking. Now we need to talk about what this means for price discovery, because this is where the entire architecture of modern financial markets begins to fracture. For decades, silver has been priced on the COMEX and the London bullion market. These are paper markets, futures contracts, unallocated accounts, synthetic exposure. The overwhelming majority of silver trading happens without any physical metal changing hands. It is a ledger entry, a promise, a claim on metal that may or may not exist, that may or may not be available when you demand delivery. And the system has allowed the financial industry to create the illusion of unlimited supply. If someone wants to buy 1 million ounces of silver, the exchange simply writes a contract. No metal moves, no vault is accessed. The price is established based on these paper transactions, and everyone pretends this represents the real cost of acquiring the actual physical metal. But that illusion is now shattering because the physical market and the paper market are diverging. In Shanghai, physical silver is trading above the COMEX futures price. Regional premiums have exploded. In some markets, buyers are paying $10, $15, $20 per ounce above the quoted spot price just to get actual deliverable metal. This is not supposed to happen. Arbitrage should eliminate these gaps instantly. If silver is cheaper in New York than Shanghai, traders should buy in New York, ship to Shanghai, and pocket the difference until the prices converge. But the arbitrage is not working. Metal is not flowing. The spread is widening. And the reason is simple. There is no metal to flow. The COMEX inventories are exhausted. The London vaults have been drained to historic lows. The Chinese have cut off exports. And industrial users, solar manufacturers, electronics producers, Electric vehicle companies are competing with investment buyers for the remaining above-ground supply. Everyone wants the same finite pool of metal, and the exchanges have been writing claims on that metal at a rate far exceeding what physically exists. This is where the system breaks. Because if you hold a silver futures contract and you decide to take delivery and the exchange cannot provide the metal, then the contract becomes worthless. It is not backed by anything real. It is a promise that cannot be kept. And once that becomes obvious, once traders and industrial users realize that the paper price has decoupled entirely from the physical price, then price discovery moves out of the futures exchanges and into the spot market for actual deliverable metal. And that is when prices explode, because there is not enough metal to satisfy demand at any price that the current system can tolerate. Let me show you what this looks like in practice. COMEX registered silver inventories dropped from 449 million ounces at the start of 2026 to 445 million ounces within days. This is metal that is supposedly available for delivery against futures contracts. But a significant portion of that metal is being converted from registered to eligible, which means it is no longer deliverable. Owners are pulling their metal out of the pool, stockpiling it, refusing to lease it, because they know the shortage is real and they do not trust the exchange to honor claims when the squeeze intensifies. And at the same time, open interest on silver futures remains at record levels. More contracts exist than metal. The leverage ratio has exploded. Some estimates put the paper to physical ratio at over 100 to 1 in certain markets. 100 claims on every ounce of actual metal. This is not a market. This is a Ponzi scheme. And like all Ponzi schemes, it works perfectly until the moment everyone wants their money back at the same time. The most dangerous signal in the market right now is not the price. It is the gold-silver ratio. For centuries, this ratio has been a barometer of monetary stress, a measure of how the market values gold relative to silver. In stable times, when the financial system functions normally, the ratio tends to hover between 55 and 65 to 1. But in periods of extreme crisis, when investors flee to the ultimate safe haven, the ratio spikes. During the 2008 financial crisis, it hit 90 to 1. During the COVID panic in 2020, it exploded to 125 to 1. Gold surged because it is the undisputed king of monetary metals, while silver lagged because its industrial demand collapsed alongside the global economy. But something different is happening now. In April 2025, the ratio exceeded 100 to 1. Gold was massively outperforming silver, as it always does in the initial phase of a crisis. But then, instead of staying elevated, the ratio collapsed. By the end of 2025, it had compressed to 57 to 1. And in January 2026, as I speak to you now, silver is surging faster than gold. The ratio is compressing in real time, and this is not normal. This is not how a typical flight to safety behaves. In a normal crisis, gold leads and silver follows, and the ratio remains wide until the crisis passes. But this time, silver is closing the gap while the crisis is still intensifying. And the only way to explain this is to understand that silver is no longer being priced purely as an industrial commodity, and it is no longer being priced purely as a monetary metal. It is being priced as both simultaneously, and it is also being priced as a strategic asset that governments and central banks are beginning to accumulate because they have realized that silver has attributes that no other asset on earth possesses. For 70 years, the rule was simple. Central banks buy gold, not silver. Gold is the reserve asset. Gold is the symbol of sovereignty. Gold is what you hold when you do not trust the dollar, the euro, the yen, or any fiat currency issued by any government anywhere. Silver, by contrast, was dismissed as poor man's gold, an industrial metal with some monetary characteristics, but not worthy of official reserves. And this logic held for decades because gold fulfilled the role of ultimate store of value, and silver was abundant enough that industrial users never had to worry about supply. But in 2026, that logic is cracking. Russia moved first. Under Western sanctions, unable to use dollars, frozen out of the international financial system, the Russian central bank began searching for assets that could withstand financial coercion. Gold was the obvious choice, but Russia already holds massive gold reserves, and further accumulation draws intense scrutiny and invites additional sanctions. Silver, however, is different. Silver has industrial demand. It is used in energy infrastructure, defense applications, electronics, all of which Russia needs to rebuild its economy and maintain strategic independence. But silver also retains monetary characteristics. It is scarce. It cannot be debased. It is recognized globally. And it is cheap enough per unit that it can be accumulated in large quantities without moving the market the way gold purchases do. India followed its own logic. Over the last 5 years, India has acquired more than 900 million ounces of silver through a combination of government purchases, corporate stockpiling, and household investment. This exceeds the reported holdings of the London bullion market over the same period. And the strategic calculation is clear. India is preparing for a world where dollar hegemony ends, where trade is settled in commodities or in baskets of currencies backed by commodities, and where silver functions as a neutral, universally accepted medium of exchange that no single country controls. Now, some of this accumulation is happening through unofficial channels. Central banks do not always report their silver holdings the way they report gold, but rough estimates suggest that from the second half of 2025 into early 2026, emerging market central banks may have acquired several hundred million ounces through various routes. And if this trend continues, if central banks begin treating silver as a reserve asset on par with gold, then the entire pricing structure of the silver market will be rewritten. Because once silver transitions from an industrial commodity to a monetary asset, the gold-silver ratio becomes the anchor. With gold at $5,000 per ounce, if the ratio reverts to its long-term band of 55 to 65 to 1, silver should trade between $75 and $90 per ounce. But history has seen brief, extreme bull phases where the ratio compressed to 15 or 20 to 1. In 1980, at the peak of the Hunt brothers squeeze, the ratio hit 14 to 1. If that happens again, if the ratio compresses to those levels, you are looking at silver trading between $250 and $330 per ounce. And this is not speculation. This is arithmetic. If gold is repricing against fiat currency and silver is repricing against gold, then the mathematics lead you to prices that seem absurd today but will seem inevitable in hindsight. But there is another force at work here that almost no one is discussing, and it may be the most important driver of silver demand over the next 5 years: artificial intelligence, data centers. The energy requirements for AI infrastructure are staggering. Every major technology company is building out massive computing facilities that require uninterrupted power, and the only realistic way to meet that demand at scale is nuclear power. Wind and solar cannot provide baseload power. Natural gas is politically problematic. Coal is being phased out. That leaves nuclear. And nuclear reactors require control rods. And control rods are made from silver. Not a little silver, a lot of silver. Each reactor uses thousands of ounces over its operational life. And as countries restart mothballed reactors, build new generation plants, and expand nuclear capacity to power the AI revolution, the demand for silver from this sector alone could absorb hundreds of millions of ounces over the next decade. This demand is inelastic. It is non-negotiable. There is no substitute. And it is coming on top of existing industrial demand from solar, electronics, electric vehicles, and medical applications. Now think about what this means for the supply side. 75 to 80% of silver production comes as a byproduct of mining other metals: copper, zinc, lead, gold. Silver is not the primary target. It is extracted alongside base metals, and the amount of silver that gets produced depends on the economics of those base metal operations, not on the price of silver. If copper demand falls, then copper mines shut down, and silver supply drops even if silver prices are rising. This creates a structural inelasticity that does not exist in most commodity markets. Higher prices do not automatically bring more supply online, because the supply is tied to the production decisions of entirely different industries. And with base metal demand weak due to slowing global growth, with Mexico facing environmental shutdowns at major silver operations, with ore grades declining at mature mines around the world, the structural deficit is only going to widen. The most important contradiction in the market right now, the signal that reveals the system is already broken, is Bitcoin. Look at what is happening to Bitcoin while gold and silver explode. Bitcoin is trading near $89,000. It hit a peak of $126,000 in October 2025, and then it collapsed 28%, $600 million in liquidations. Bitcoin was supposed to be digital gold. It was supposed to be the hedge against fiat currency debasement, the asset that rose when central banks printed money and governments ran deficits. And for a while, that narrative worked. Bitcoin and gold moved together. When inflation fears rose, both surged. When the dollar weakened, both benefited. But in January 2026, as gold and silver hit all-time highs, Bitcoin is falling. And this divergence is telling you something critical. Bitcoin is not behaving like a monetary asset. It is behaving like a risk asset. It is correlated with tech stocks, with speculative growth, with leverage and liquidity. When the market turns risk off, when real fear enters the system, capital does not flow into Bitcoin. It flows out. Because Bitcoin has no industrial use, it has no physical form, it cannot be held, it cannot be used in manufacturing. It exists only as a ledger entry on a distributed database, and its value depends entirely on the collective belief that someone else will pay more for it tomorrow than you pay today. Gold and silver, by contrast, have 5,000 years of history as stores of value. They have survived the collapse of every empire, every currency, every financial system that has ever existed. They are not dependent on the internet, on electricity, on the continued functioning of exchanges or custodians or governments. They are physical. They are final. And in a world where trust in institutions is eroding, where central banks are losing credibility, where governments are weaponizing currencies and freezing assets and imposing capital controls, physical metal is the only asset that cannot be confiscated electronically, that cannot be debased by a keystroke, that cannot be erased by a system failure. This is why gold and silver are rising while Bitcoin falls. The market is making a choice, and the choice is reality over abstraction, substance over promise, metal over code. The dollar is dying, but not in the way most people imagine. The dollar is still the world's reserve currency. It still dominates international trade, still accounts for 60% of global reserves, still underpins the majority of financial transactions. But its purchasing power is evaporating. The dollar index fell 11% in the first half of 2025, the largest six-month decline in decades. And the expectation among strategists is that the dollar will lose another 5 to 10% in 2026. Some forecasts call for a total decline of 20% from peak to trough. This is not a technical correction. This is a structural repricing. And the cause is simple. The United States is running a $37 trillion national debt. Interest payments on that debt now consume 40% of all federal tax revenue. The government is borrowing $1 trillion every 100 days just to pay the interest on previous borrowing. This is a debt spiral, and there are only three ways out. Default explicitly, default through inflation, or print money and pray. The political class has chosen door number 3, and the consequence is that every dollar in circulation, every dollar in your bank account, every dollar in your paycheck is worth less today than it was yesterday, and it will be worth even less tomorrow. Gold at $5,000 is not a sign that gold has become more valuable. If you held 1 ounce of gold in 1995, 30 years later you still have exactly 1 ounce of gold. The metal has not changed. What changed is how many devalued dollars it takes to buy that ounce. In 1995, gold traded at $380. Today it trades at $5,000. The metal is the same. The currency is not. And silver, trading at $102, is telling the same story but with greater intensity because silver is smaller, more volatile, more responsive to shifts in sentiment and supply. When the debasement trade accelerates, when investors realize that holding cash is a guaranteed loss of purchasing power, they move into hard assets. And silver, because it is affordable, because it has both monetary and industrial characteristics, becomes the preferred vehicle for this rotation. Now, think about what happens when settlement time comes. You buy a futures contract. You expect delivery, but delivery takes time. The metal has to be located, it has to be moved, it has to be assayed, it has to clear customs, and during that time the price can move. If silver is rising 5% per week and your settlement takes 3 weeks, then by the time you get your metal, the market price is 15% higher than what you paid. And if you are an industrial user, if you need that silver to manufacture solar panels or electronics or medical devices, then you are now underwater on every forward contract you signed. This creates a scramble. Companies that relied on futures to hedge their exposure suddenly realize that the hedge is worthless if they cannot take delivery. They start bidding for physical metal in the spot market, paying premiums, offering above market prices just to secure supply. And this drives the physical price even higher, which makes the paper contracts even more disconnected from reality, which forces more buyers into the physical market, which accelerates the squeeze. This is not a cycle. This is a spiral, and it ends only when the paper market collapses entirely, when futures exchanges suspend trading, when contracts are settled in cash instead of metal, when the fiction of unlimited supply can no longer be maintained. And at that point, the only price that matters is the price of physical, deliverable metal in your hand. Everything else is a promise, a claim, a hope. And promises do not keep their value when the system is breaking. So what does this mean for you, right now, in this moment? It means that the old rules no longer apply. The idea that you can hold cash, earn a modest return, and preserve your wealth is dead. The idea that diversification across stocks and bonds will protect you is obsolete. The idea that the Federal Reserve will step in and fix everything is a delusion. The system is designed to transfer wealth from savers to debtors, from cash holders to asset holders, from those who trust the currency to those who understand that the currency is being destroyed by design. And the transfer is happening right now, in real time, with gold at $5,000 and silver at $102, with inventories collapsing, with ratios compressing, with central banks accumulating, with industrial users scrambling, with the paper markets diverging from physical reality. You are watching a regime change, a monetary reset, a repricing of value itself. And the only question that matters is whether you are positioned for what comes next, or whether you're still holding the asset that is being deliberately debased to pay for the debts, the deficits, the promises that can never be kept. Time is not neutral. Time is your enemy if you are holding cash. Because every day you wait, every day you sit on the sidelines, is another day that your purchasing power erodes, another day that the metal moves higher, another day that the gap between paper and physical widens, another day closer to the moment when the exchanges can no longer deliver, when the vaults are empty, when the price you see quoted on a screen has no relationship to the price you must pay to acquire the actual, tangible, deliverable asset. This is not a prediction. This is not a warning. This is a description of what is happening right now. Silver is no longer contained. The system that suppressed it for decades, that created infinite paper claims on finite metal, that kept the price artificially low to maintain the illusion of dollar stability, is breaking. And once it breaks completely, once the paper market collapses and price discovery moves entirely to the physical market, you will look back at $102 per ounce and realize that it was not expensive. It was the last moment before the real repricing began,